I'm going to have a seat for this. Introduce myself. I was introduced Charlie LeGrays. I'm with Investment Property Exchange Services, Inc., IPX 1031 for short. I am actually filling in for my boss this evening, Mr. Craig Brown. He's South Central U.S. Regional Manager. He's our lead legal counsel and legal review attorney for Texas, Oklahoma, Arkansas, Louisiana. Man knows more than I'll ever learn. But for my purposes, I started in the industry a little over 19 years ago. I was a processor, not an attorney, but I've been in the trenches with folks trying to complete transactions, doing exchanges, and seeing the mistakes that they've made and helping them overcome those errors if at all possible. I've been involved in easily 15, 16,000 exchange transactions over my career, probably more. But I was doing 120 to 150 a month myself. So, senior coordinator, now they let me sit back and do some of the easy work. But in that Mr. Brown was double booked, he asked me to come out and speak with y'all this evening. I have an outline. I think there's a copy of Mr. Brown's outline inside of those manuals if you want to look at it. But I'll probably deviate a little bit. Basically, when I do these presentations, I treat them as if I'm talking to most of my clients I talk to on the phone. That's how I meet them. We have discussions. I explain the scenario. I get their what it is they're trying to accomplish, what their transactions are, and I cover basics with them. So it's kind of the way that I like doing it. In that, it may be a little bit boring for somebody that knows 1031 and uses them all the time, but for those of you who've never done it or thought maybe it might be useful for you, hopefully it'll give you some basic information to make you inquisitive next time you're ready to do a transaction. Doesn't hurt to make a call. Let us know what you're doing, and if we can help you, we'll let you know and help guide you through the process. It's not that difficult a transaction as long as you stick to the rules. Okay, anybody in the room that has done 1031s before? Whatever did you succeed in?
Yeah.
You got through it full?
Five of them. We did 5 of them in the summer of 2016, and was able to get all the money in except for about $4,000.
Okay, so 5 separate or 5 properties?
Yeah, we had to pay tax on 4,000. Okay. Versus, quite a bit more.
Partial exchange, and that's one of the things about 1031. It's not always all or nothing. In a lot of instances, people will gain a partial default. Maybe they have $100,000 worth of gain and they're able to wash all of it, but $5,000. In that case, you're still a whole lot better off than paying the capital gain on the whole $100,000 of your tax obligation. So, briefly, 1031 has been going on since the early 1920s. Started out like the old days when people used to trade pink slips on automobiles. My car for your car, they swapped pink slips. That's how 1031 started out. It was initially a scenario where it was an even swap, no inequity whatsoever. 2 people had real estate. I'm going to trade you my 5 acres for your 5 acres. They did the swap. They signed the deeds. No exchange of equity, and the IRS let them assume that they had moved their tax burden from the original property to the new property without incurring any gains tax. In other words, no constructive receipt of any equity. They just swapped positions. That's how 1031 existed for a long time. Then, in 1979, a case called Starker versus the Commission. Starker, a lot of people will recognize that as the name of one of our competitors. The Starker Exchange is not named after our competitor. It's named after the actual lawsuit or the case where it's really when what's now called delayed exchanges became part of what the IRS would allow. Used to be it was a sit at the table swap. Then they decided, okay, an individual can sell their property and then turn around at a later date and buy a replacement property. And as long as they're not touching any cash in the transactions, then it's legitimate. We'll let you do the swap. And in those scenarios, 1031 intermediaries came into being basically as an intermediary. It's our job to hold the money. You go to sell your property, if you touch the cash proceeds from your property, take constructive receipt of that money, at that point you owe the capital gains tax on the sale of your property. If you do a 1031 exchange at time of sale, we take possession of the money, we assign on to your contract, to be your intermediary, we contract with you to perform the functions that we're being paid to do. And then when you're ready to buy your new property, we fund the purchase. And the money is totally brought around your receipt. You don't touch it, thus it's rolled into a new property. The capital gains tax is not due. That's the kicker of basically what we do. We help people avoid constructive receipt of sale proceeds in order to basically roll their tax basis into a new property. In 1991, the regulations got much more formal. People were starting to do 1031s, and it was kind of a loosey-goosey industry, and the IRS said, hey, we're going to put a halt to all this. So they came out with a straight code. They installed time deadlines. They kept some of the things that used to do, the delayed exchange. They eliminated some of what they used to allow. But the main thing that came out of it was the establishment of time deadlines for the exchange. That's one of the other major points for a 1031 exchange. So basically from 1991 and on, I think I started in 99, the modern code has been being built, and it's constantly being changed. One thing about the about the tax codes in general, the IRS, when they're writing code, they write things in to be gray. It's not black, it's not white, it's gray. They leave themselves wiggle in their minds to be able to handle whatever situation is presented to them. But at the same time, they're leaving wiggle room to exchangers because the code is gray. So over the years, people have been pushing the boundaries. And, over the years, the IRS will say, for instance, what's called a reverse exchange. It wasn't possible, but people started to do it. And after a number of years, the IRS finally threw up their hands. Everybody's doing it, so they wrote it into the code, and they put rules on what you had to do to accomplish it. So the codes are, constantly changing. Good reason to deal with a company such as ours. We're IPX 1031, we're nationwide, the biggest intermediary in the country. It's not an expensive transaction for standard exchanges. In fact, most of the competition chases us on fees. We do so much volume that we can take lower fees than a lot of other companies do. All right. First thing you're dealing with 1031. Like-kind property. I assume most of y'all deal with real estate transactions and real estate investments. In the eyes of the IRS, like-kind property is any form of real property, period. Anything that qualifies for real property rights. And, that could be land, typically rental houses. Land and improvements are sold, could be a commercial strip, it could be farm and ranch, it could be timberland. Anything that's deemed to be real property is seen by the IRS as being like-kind with any other type of real property. That also includes royalty interests. Our area of the country, and I'm the regional offices out of Dallas. Royalty interests in oil and gas. Royalty leases, working interests in land. Timber rights to land. Leasehold interests to land, provided they're 30-plus year leasehold interests. They're all interchangeable. So you can sell a small commercial strip or sell 8 or 10 small rental houses, bundle them all together and buy mineral rights, or buy some farm and ranch land. Hey, I want to retire. I'm tired of living in the city. I'm going to buy a little ranch down here and roll my gain into it And then after operating it for a while, convert it to your primary residence. Relieve yourself of the game, basically. Okay, uses. Like I said, any form of investment real estate is like kind with any other form. It's all interchangeable. It's not the type of property that will qualify or disqualify a property for 1031 purposes. What will qualify or disqualify it is the use of the property. To qualify for 1031 exchange, a piece of real estate, real property must, as I mentioned before, be land with things that are permanently attached, dwellings or commercial structures, any type of strip mall, rental houses, and properties that are used for productive use in trade or business. In other words, you're going to rent a property. I'm going to buy it, I'm renting it, that's my business. Okay, so that qualifies it as investment real estate for the IRS. Or if you have a property that you operate your business out of, that is equally considered productive use in your trade or business. When you're doing an exchange, mixed uses of property are allowed. As I mentioned, you can sell 5 or 6 rental houses and determine I'm going to buy some ranch land. And because they're like kind, they're interchangeable. You can sell one type, buy the other. You can sell mineral rights and turn around and buy a commercial strip. As long as it's real property, it's deemed like kind and allowed to be exchanged. Now, one thing a lot of people get into is how long they have to hold property. And I know a lot of folks in this room heard mentioned earlier of buying a property for rental, or you might turn around and flip it. Okay. Property that's acquired or sold in exchange, the IRS does not physically give a time frame. They don't tell you you've got to own it for X amount of years. Or when you buy a replacement property, you have to hold it for X amount of years. For a standard exchange, it's that's one of the gray areas. They're going to look at one of two things. Has the property been held for investment purposes? Or has it been held, was it acquired and held primarily for resale? In other words, flipped property is not going to work. Some people will try it, and quite frankly, we don't know what people do with the property after they buy it. Once they buy it, they're on their own. If they turn around and flip it and the IRS audits them, then they may have trouble defending the stance that, hey, this is investment property. I did not intend to resell it immediately. That's a gray area that you got to deal with. Now, the resale thing can be put down in like this. You buy a house that you're going to repurpose, that you're going to rehab and put on the market for sale. Now let's say you rehab it for a month or two, and then you put it on the market and sell it. If you don't get challenged with the IRS, everything works, but you're rolling the dice. It's not recommended because if they do challenge you, they're going to come up and say, hey, they're going to look at what you did, look at the time frames involved, particularly if you do a lot of flip properties, and they're going to say, hey, you intended to flip this property, it's not qualified, so you have to pay gains tax, no exchange. Same scenario, let's look at somebody who does mixed use with properties. They flip some, and then they have other properties that they purchased that, they may sit on them for 4 or 5 years, rent them, and then when the market's right, they'll turn around and sell them as they see fit. But they've made a habit of doing that in their business. And let's say they've had the property for 3 months, and somebody approaches them and makes them an unsolicited offer of a windfall. It's like, I wanted that property. You got it out from under me, and I'm willing to pay you X amount of dollars on top of what you paid for you to sell it to me right now. That's a transaction that may work. Even though you're reselling it really quickly, You've got a history of holding some of your property for a length of time. That's a leg for you. And you have the scenario where you didn't list your property for sale. You made an unsolicited offer. So you can reasonably expect to be able to defend the stance that you acquired that property to hold for investment, not to turn around and resell. So again, it's a gray area whenever anybody that does a lot of real estate is looking at a transaction and they're not sure whether the 1031 might benefit them or not, we're a phone call away. And if it's a doable transaction, we're gonna give you your options. And the first thing we're gonna recommend is, hey, talk to your accountant. Let them be your guide. Tell them what you're doing. Tell them what we've offered, and see if they think it's the right transaction. We're not accountants. As an intermediary, we can't be an agent. If we're acting as an agent, we become disqualified and no longer able to do your exchange. We're technically a disinterested third party that performs the service, handle the money. So, it's, if there's information we can give you, we'll give you the information, but we can't help you make up your mind. All we can do is give you the options, and then yes, sir.
I was going to say, would you rather questions be held to the end?
No, if somebody has a question, like I said, I deal with clients on the phone. I'm not used to public presentations.
Gotcha.
And one thing they do is every third word out of my mouth is asking questions.
Okay.
And in the long run, when dealing with a client, I'd rather them do that because I can get to the root of what they're really wanting and what their intentions are quicker. So, go ahead.
My question first.
Sure.
How long is your presentation without questions?
Without questions, I was told an hour. This is an outline that I'm going to wing through. It may be 45 minutes. It may be an hour. They may tell me, "Hey, we got to go."
Right.
So, but I don't mind the questions because a lot of times I can cover things that have yet to be covered and just we can address it piecemeal.
Thank you.
So,
The question that I had more so was, without you giving tax advice or legal advice, right? Because we know that's not your skill. All right. I just want to make sure everybody knows that you're not giving that. Do you have people that, like we were told at one point to put our flips in one LLC, run the books on that, and then our rentals in a different LLC because you don't want to treat flips as inventory and get taxed as a dealer and lose your depreciation?
to me, and I can't speak for the legal aspect of it, but that's a leg in the table you're trying to build.
Okay.
I do both. I have one business entity that handles my flips. I have another business entity where I part deed to the properties that I manage as income producing properties. So if you want to sell one of the flip properties, put it in the other one and hold it that way for a couple of years. And you can turn around and qualify. And you may get a better price for the property in the long run if you're going to turn it over quickly. And it is what it is.
For those people who are brand new here tonight, it might be really good if you just step back and say, why would you want to do a 1031 exchange and what it is?
Good. I probably should have thought of that first. But like I said, people call me. They already know what they want when they're on the phone. 1031 exchange, for people who are not familiar with it, if you sell real estate, and if you sell a lot of other types of properties that you can hold, but in particular real estate, when you sell, you have to pay capital gains tax on your profit of that sale. And it can be a combination of the things I will cover is tax basis. But basically, when you buy a property, your tax basis is what you paid for. That can adjust up and down, depending on what you do during the ownership. But basically, if you buy for $100,000 and you sell for $200,000, you've got $100,000 worth of gain. And the IRS is going to want their credit if you take cash. So, in scenario of a 1031, what you're looking to do is to defer all or a portion, as much as possible, of the gain from that sale. And what you're doing is saying, you, Mr. IRS agent, I sold this real estate, and I found this beautiful piece of property over here. It's like kind. I can exchange it. I'm gonna buy this piece of real estate, and I'm gonna roll my capital gains tax into that new property. I don't touch the cash, don't have to pay the tax. Basically, what you've done is taking your tax position from the first property, hold it over into the next property, and you keep your money. Yes, ma'am.
What is the tax difference if you hold the property for 1 year, 1 day? What's the?
There really isn't. There's a lot of misconceptions about time deadlines, but as I mentioned, the IRS doesn't put time on it. They don't give a specific time. They don't want to give you that rule. They want to catch people. That's their job, to get you to pay money. Our company recommends hold for 2 years. At minimum, hold for at least a year. But I've had people that turn around within a month or two, as I mentioned, unsolicited offers, and turn around and resell property and want to do an exchange. And there's nothing that prevents us from opening the file. We're gonna strongly urge them to talk to their tax specialist or their attorney and make sure that it's beneficial for them. But I've had people turn around in a very short time frame because the IRS doesn't give you that guideline in general. Yes, sir.
Do you have a time frame? Say if I go ahead, I'm gonna do this exchange on a piece of property. Do I have a time frame on purchasing another piece of property?
Yes, sir. That's something that I'll cover now instead of later. In the 1031 exchange, in or around 91, I mentioned they actually wrote the code. And they put, one of the things they put in were time deadlines. Day zero for an exchange is the day your sale closes. Technically what it is the point at which the benefits and burdens of ownership of your property passes from you to the new owner. That's what the IRS will recognize. Some people don't use closing statements. So a lot of times mineral rights are not closed with a closing statement, so we may have to use the deed, date of recordation of deed. In some instances, we had to use the actual date of funding. But that beginning point, from then on, you have 45 days in which to identify the property or properties that you intend to purchase. That's calendar days, that's not weekdays, so it includes holidays, weekends. You know, if your deadline falls on a Sunday, tough, get it done by Sunday. You know, you got a property ID, you got a little form, you write down your properties, you sign it, date it, email it to us. As long as we get it before midnight on that deadline date, it's valid. If it comes a minute after midnight on the tide stamp, we can't accept it. So, you know, they're real rigid with the time deadlines.
So you have to identify the piece of property that you're going to purchase, or do you have to actually get and purchase that property?
No, 45 days to identify. And the rules, which I'll cover in a little bit, the rules will give you some leeway to be able to identify the property you think you want, and maybe a couple of more as backups just in case. But the way real estate markets have been lately, backups don't stay on the market long. So if it's a property that you really want, get out there and get it contracted. Lock it in so that you know your ID is good. After day 45, you can't change it and you can't quit. You identify a property, and if you choose not, or if you can't negotiate on that property and get it closed, the IRS says tough. You've got to wait till the final deadline for the exchange to recoup your money. It's the rules. And that second deadline is 180 days from the original day zero. Within 180 days of the day you close on your sale, the benefits and burdens of ownership pass, you must close on all property or properties that you intend to include in your exchange. And it may be multiple, it may be just a single property. But the day after day 180, it's too late. You can close on it, it's not going to count. So they are real strict with those deadlines. You got to meet the deadlines.
So after day 180, do you pay taxes on
After
capital
day
gain?
180, we cut you either wire transfer or cut you a check at your discretion. All the money back into your account, short our fee.
Yeah.
And at that point, you have to get with your accountant and figure out how you're going to deal with it.
Gotcha.
Tax man.
Okay? Yeah, talk to the tax man. Now, as far as dealing with the tax man, one strategy, just because it popped in my head. This time of year, we get, not a lot, but we get some exchangers that are savvy, that have done this, that will sell property with no intent to buy more property. They don't intend to complete their exchange. They don't want to buy property, but they know one thing that a lot of folks don't. If your exchange rolls from one year into the next, day 180, like you sell in 2018 and day 180s in 2019, and you don't buy any property, you can't have your money back until 2019, when the exchange terminates for time deadlines. If you started your exchange the year prior and received your cash the following year, that gives you the option of determining which year you choose to declare your capital gains. So
you say
if,
2019 instead.
exactly, you go with your account and you start structuring. It's like, what losses do I have this year? Should I wait and put it on the next year? What losses can we write off the next year? And that gives you a chance to at least structure your taxes that are, so that they'll come out to your best benefit. Again, that's something a lot of folks don't realize about 1031, but it's one of the quirks. One of the biggest clients I ever worked with, they do their own 1031s now with our partners. We used to do several $100 million exchanges with these people 4 or 5 times a year. And anything for the first half of the year, they would complete the exchange. Anything second half of the year, they'd never buy anything. We'd sit on that money for 180 days, give it back to them, and then they'd let their accountants do the work. So, it's a potential strategy for folks. So the 45 and 180, was that clear for you?
Yes, it was.
Okay. There's, they're not forgiving about the deadlines. But if you know those deadlines are there going into it, a lot of people will already have their sale and purchase contracted before they even close their sale. A lot of them will do it the same day or the next day, and the transaction's real short, real easy. They sign papers, it's done. And some people, they go through the whole process. It may take them 180 days to complete the exchange. We get all kinds. So it's what's open and available. Yes, sir.
How do you treat the equity? Say I trade with a person for $100,000 property,
Mhm.
and I have a 200, so I have 100,000 in equity.
Okay, so he's going to give you $100,000.
But
He's going to give you his property plus $100,000
that's what
for
I'm
your
saying.
property.
How
In that case, you would basically, for his purposes, he has a complete exchange. He sold $100,000 to you and bought $200,000. His exchange is done. He gets a deferral. In your case, you have bought one property. So for 200, you got to buy 200. Okay? So you bought one property. That means you got cash equity, and you have 45 days to identify a second property and 180 days to complete the transactions. Or when the 100,000 comes into your possession, it'll be treated as cash boot, and you'll have to return. And if I use the word boot, boot's a term in the industry for basically for cash or other forms of equity that you receive in an exchange transaction other than real estate. So cash boot is taxable. All right. There's a couple of instances where there are time deadlines. One that comes in key for people is conversion of a primary residence. Somebody's going to sell their primary residence, and of course you get an exemption, $500,000 exemption for the sale of a primary residence if you're a married couple, $250,000 for individual. But some people will sell property that's much more expensive. The key is if you're going to sell along those lines and you want to try to exchange to cover the additional values, it's a 2-year process. The IRS says you can convert that property to investment property, but you got to hold on to it for 2 years. And for 2 years, you can't use it more than 14 days a year. And you must rent it out for a minimum of 14 days a year. So basically, they put a halt to people trying that, unless you're in a position where you can buy your new house and just put it up for rent, put the old house up for rental for a couple of years, and they'll allow you to, instead of treating it as sale of primary, they'll allow you to sell it under a 1031. Then the question is that to your best benefit? Question for your accountants.
Now, also, is it some type of exemption on the taxes 3 to 5 years if you hold your homestead and so?
Well, sale of a primary, yeah, that's it. It's an exemption, it's not a deferral. 1031 is a deferral. You roll on the gain into a new property. If you sell that property and you don't do another exchange, then you deal with the gain later. Or you can keep doing exchanges over and over again. Some people, the other aspect of this primary, some people will do an exchange. They'll sell 5 or 6 rentals. They want to buy high dollar beach property or property in the mountains, someplace where maybe they're going to retire, or they just want to move to that place and raise their family. They got the financial wherewithal. They can do an exchange out of their investment property, buy that property that will eventually be their primary, hold it for 2 years as investment property, and then convert it to a primary residence. When you convert it, it's no longer a deferral, it's an exemption. And you don't have to account for the gain that came out of your investment property. So you make it a primary residence, and it is no longer taxable under 1031. Until you go to resell it, if you have appreciation beyond 500,000, then you might have tax consequences later.
I got a question.
Yes, sir.
Within that 2-year period, do you have to rent it out for like 14 days, like you mentioned?
When you buy a property, when you go to sell a property that's been a primary, you've got to meet those hurdles. Okay. If you buy a property as replacement that you intend to convert down the road, you simply have to hold it for investment purposes. Now, the question is, are you going to want that property just sitting, not producing any money when it could produce money for you, own it for 2 years, and then turn around and rehab it for 6 months and move into it? That way you get the house you want, it's been income producing for you, and you can wash a lot of gain out of whatever properties you sold to buy that, roll it into. So again, it's just a strategy. There's a lot of things you can do if you get creative and start asking questions. The best person to ask actually is Mr. Brown. Craig has seen so many transactions and things that I thought never were going to work. And he's like, oh, we can do this, we can do this, you can do this, you can do this. Call your CPA, let's get on a phone call. Maybe explain it to them, and then they can tell you what to do. Yes, ma'am.
Is there a maximum amount of tax dollars that you can just roll and roll?
Yeah.
Thousands, millions?
And you can roll it over and over again. Everything. If you do a 1031, got a lot of exchangers. There was a gentleman, I won't mention his name, but he's from San Antonio. And I'll give you his first name. Leonard, I believe, over the course of 7 or 8 years, bought an entire lower income neighborhood. He bought everything he could get his hands on. He bought. And he rented them out for a fair price. He had a good business, built them up a little bit, rehabbed them, made them nice, helped to improve the neighborhoods, and then he decided, I'm moving to Florida. And piecemeal, over 5 or 6 years, he sold them all. But he sold them one at a time. Some of them he cashed. He said, okay, I'll take this little bit of gain, and I'll pay for it. And this one I'm going to exchange. And he, when he was going to exchange, he'd usually try to put 5 or 6 together so he could turn around and buy a nice property down in Florida with them on. So he used a strategy to start divesting himself of properties and put himself in the place he wanted to be, but he built up his business in the place where he lived. So, it's a tool to use. Anybody that's interested in saving some money on their real estate transactions, as long as they're selling. All right, basics of completing the exchange. You need to know some numbers. What's your gross sale price? You better know that when you sell it. How much are your closing costs? And how much debt relief is there? Obvious, you take your sale price, you deduct closing costs, deduct your debt relief, you don't know how much equity you got left over. In the 1031, that equity is one of the key numbers. Okay? When you buy real estate, to get a full deferral, you must purchase property equal or greater in value to the property you sold. You sell for $200, they'll let you take your closing cost off, but basically you gotta buy it for $200. And you gotta reinvest your cash. If you buy down in value and you reinvest all your cash, then what you're technically doing is failing to replace some of your debt. You can do that, you gotta pay tax on that shortfall. But the cash has to be reinvested. If you buy the property, increase the amount of debt, want to keep some cash in your pocket, they're going to tax you on that receipt of boot, of the cash boot from your sale. So that is key. You must put the money. As far as determining what the tax on the property is, you need to know what your adjusted basis is. As I mentioned, when you buy a property, your tax basis is what you paid for that property. Now, let's say over the course of years, you make capital improvements to that property. Those capital improvements increase your tax basis. Now, I'm not talking carpeting and paint, but actual capital improvements. I'm going to take a garage and I'm going to build it out to be an additional bedroom, or I'm going to build a mother-in-law suite on the back of the property. Actual capital improvements to the property. From that, you subtract depreciation on your property. I'm sure most of y'all that have investment property depreciate. So at the time of sale, you may not be aware of it, but the tax guys, if you've taken $10,000 worth of depreciation upon sale, you got to recapture that 10 grand. So they're going to use that to reduce your tax basis. The lower your tax basis, the more tax you owe the IRS, or the more gain you have to account for. Basically, you take your sale price, add appreciation, capital improvements to increase the depreciation, and then subtract that from the sale price. And that will tell you how much gain you have. It's not necessarily how much cash you have. That's the actual capital gain that you would have to pay taxes on if you just sold straight up. Yes, ma'am.
Could you repeat that again about your thing about capital gain?
Okay, capital gains, basically, are you square with the basis?
Yeah, I just wanted to hear what you said, the sale price.
Plus the value of capital improvements, minus depreciation taken, and that will give you your adjusted basis, adjusted tax basis. Then subtract the adjusted tax basis from the price of the property you sold. That's going to give you approximately how much gain you have. Even if there's no cash involved in the sale. Another little hint. Refinancing before sale, the IRS doesn't like that. But if you know you're going to sell the property, refinance it the year before. Pull all your cash equity out of it. That way when you sell, it's virtually all debt. I've had some savvy exchangers in the past who they sell their properties and there's no cash. We hold money, but we also handle the transactions. We assign in and out of the contracts to make everything work. So all they're doing is replacing debt. They're buying property equal or greater in value, and they're putting as little cash into it as they have to. And that way, they kind of have their cake and eat it too. They pull their equity out, they have it in their pockets. They've taken on debt for the equity, but when they sell the property, they pay it off the debt. Then they can choose how much they want to put into the next property. They've cleared that cash out. Did that help you? Did that help him?
Me?
Yeah.
Clear as mud.
I told you
I'm
I'd
just
be
kidding.
rolling back in your sockets. Okay. If they talk here about money for down payment, it's not down payment, it's how much cash you have to put in. And to get a full deferral, you have to reinvest all your cash and replace the value of the debt on your sale. That replacing value of debt relief that's a loose kind of a term. Reinvesting the cash has got to take place. If you keep any of the money, you pay the tax on that money. Replacing the value of debt relief can be done in any number of ways. You can take on new debt, you can come out of pocket and just buy cash. Or you can trade some other thing of equitable value. The seller wants, you got stocks and the seller's willing to take some stocks in exchange for part of his profit. It doesn't matter how you replace debt as long as the dollar amount's replaced. The cash has to be the actual cash investment. Okay? Full deferral is full replacement. A partial deferral is a scenario where I gotta buy 200,000, but the perfect property for me is only 175, and I don't wanna buy a second property. So, you buy down in value, you have to account for the tax on that shortfall. You may not pay any tax, you can't maybe able to write it off, but you've got to account for that $25,000 shortfall. It's a scenario that comes into play often. And keep one thing in mind. If you're doing an exchange and you're buying down in value, and you know I'm gonna have to pay some tax on this shortfall. The IRS isn't gonna tax you twice. So let's say in that sale, sold for 200, I'm buying for 175, I got 100,000 in cash. You're gonna already pay the tax for falling short of 25. They're not gonna double tax you, so if you want, keep 25,000 of that cash back and keep it in your pocket. You've already paid the tax on it. And then, if that's the way you want to go, then invest the remaining 75. Again, another reason to have a good qualified intermediary that can help guide you through the process, so you're not just going blind into it. Yes, ma'am.
In your experience, in your opinion, do you feel like people that do a lot of 1031 exchanges get audited?
No. People who do 1031 exchanges and push the envelope may get audited more, but because they're being creative, and that's how the code expands. Reverse exchanges didn't used to be allowable, and in recent years, the IRS finally gave up and said, okay, we allow reverse exchanges. If you follow the rules, you can buy before you sell. And the rules are very strict and rigid, and it's an expensive transaction, but it can be done. But, it doesn't make you, it's really commonplace. When I first started in the industry, our numbers, volume, and I started out in the coastal St. Augustine, Florida, and condos were hot. And right here in Texas, we're doing twice the volume that we did in the Florida region. And Florida was one of the gung-ho districts for IPX at the time. So, it's getting more and more popular. More and more people are buying and selling real estate for either for quick cash infusion or for managed income down the road to be able to create that income stream for yourselves. And I don't need to cover that. We kind of already covered it. Okay, improvements. There's a couple of specialty kinds of exchanges. They're a little bit on the expensive side. Some people will buy dirt and want to put up their own house. Or buy dirt and put up a commercial property. Or buy a commercial property and spend extensive money rehabbing that property. The IRS won't let you as an exchanger use deferred dollars to improve a property that you already own. So once you buy it and take deed, all bets are off. You know, you just gotta find something else to spend that money on or take the in exchange. However, there is a form of an exchange that is specifically for making improvements. It's called a build-to-suit transaction. At the time of sale closing, the deed for the property that you, well, pardon me, purchase closing, my bad. At the time of purchase closing, somebody buys their replacement property and they tell us, hey, we want to make improvements to this property. So we set it up, we form a single member LLC specifically for the purpose of handling this transaction. It's called an exchange accommodation title holder. The deed to the property that's being bought at time of closing passes into that LLC. We sit on it. And since you haven't taken possession of the property, you can continue to use deferred dollars out of your account to improve that property. And basically, you direct us who needs to be paid. We issue the checks or make the money transfers during the build out. And you have until day 180 to get as much completed as possible. And at that point, either at the point where you've done your construction or you hit the final deadline, everything that's been completed to that point becomes part of your replacement property. And we transfer ownership of the property back to you. That way, you didn't own the property and you were able to improve it with those deferred dollars. Those transactions start around, they used to be $5,500, probably $7,000, and they go up from there. So in smaller transactions, it's not a viable thing. Typically, was my experience, until somebody got 350 to 500,000 and up before it was justified by, by the expense. And before they had a property that was really worth looking into doing that kind of major expense to make improvements to. Yes, sir.
Real quick, and this could be a two-part question, so I apologize.
No,
Your 1031 exchanges, are they bound to an LLC or they actually pass through and it's on you as an individual?
for you, a standard exchange, it's up to you as an individual.
Okay.
You contract to sell, we assign onto your sale contract to be your intermediary. We take possession of the cash proceeds. If you decide to take some cash boot at closing, you can do so, but the remaining proceeds come to us. Then when you're ready to buy your replacement property, you contract to purchase and send us the contract, title agent's info. We draft the documents to effect funding the purchase. Basically, we assign onto that purchase contract to be buyer for you as your intermediary. We're a direct deed company, so ownership does not come to us unless you're dealing with those specialty exchanges that require us to take deed. The standard exchange, it's straight between the parties.
Okay, so the second part of that would be, let's say, just because it happened earlier this year, we've got our rentals in one LLC, flips another, right? So we sold one of our rentals and made a decent profit. So with that, we just applied that to the principal of one of our other duplexes and wiped it clean with zero balance.
Yeah.
Would it have been possible to have sold that, even though our LLC owns that property already? Could I have sold it into another LLC and used the capital gains?
Probably not, but that'd be a question for the attorneys.
Okay.
For Mr. Brown. Typically, what you're talking about doing is
Rebuying.
selling,
property.
buying property
Yeah.
already on it.
Yeah.
Or paying off debt against the property.
Yeah.
That's not gonna be seen as acquiring real property. So it probably wouldn't. Now, if you're dealing with different LLCs and they're separate taxpayers, you may have a way to work through it, but that's for somebody with more knowledge than me as far as the legalities of the transactions. Okay, and if you do those improvements, exchanges, you're still bound by the time deadlines. When you do your identification, you gotta identify the property and you gotta identify the proposed improvements. Okay? Gotta tell them what you're gonna do. And you gotta have it completed by day 180. Or, you'll get credit for everything fully completed up to that point, but you may not finish your whole transaction. Okay, holding requirements, we pretty much covered all that. A couple of different types of exchanges. Simultaneous exchanges, is what the gentleman over here was talking about. Basically, swapping properties. Okay, that's the old form of doing it. You know, we sit down at the table, we trade deeds. Sign the papers, it's over with. I have yours, you have mine, they're equal value. Then there's simultaneous exchanges where, as he said, we swap property, but mine's more expensive, so you owe me your property and $100,000 for mine. Okay? That can be done in that case. Then the gentleman who is receiving the cash has to buy more replacement property to wash that cash through. Delayed exchanges. A delayed exchange is a four-party exchange. The four parties, you the exchanger, us the intermediary, the buyer of your relinquished property, and the seller of your replacement property. There may be more. You may sell multiple properties. You may buy multiple properties, but every delayed exchange is going to be a minimum of four-party transaction. So, and we coordinate all that in the documentation. There's in those handouts and at the back of the booklets, there's cooperation language. A lot of people think you got to have 1031 in your contract. No, you don't. The requirement by the IRS is that the other party be notified in writing on or before the date of closing that you're going to do a 1031, or that you might do a 1031. Our cooperation clause in those can be used as an addendum to the contract, or you can pull off the appropriate language and write it into your contract. Or some contracts have standard language built in for 1031, check the box. But basically, it's asking their permission to cooperate with your exchange, provided it's not going to cost them anything, it's not going to delay the closing. So most people will sign it up front. Our documents, basically we have a contract, exchange agreement, in terms of what service we provide. It also outlines the things that you're responsible for, such as meeting the time deadlines, if you want a full deferral, buying enough property, following the guidelines as you're instructed, and when necessary, seeking out tax advice from your tax advisors. I've mentioned it several times. Another document is our assignment of contract rights. That's how we take part in each of your sale and purchases. We assign on to be your intermediary, and then the backup of this cooperation language, our assignment document already also has a notice to the buyer or a notice to the seller, where when they sit down at closing, they're presenting a copy, and it says, you, the exchanger, are effecting a 1031 exchange with investment property exchange services. We're giving you written notification on before the day of closing. Please sign. And if they refuse to sign, the title agent can sign it saying, I gave it to them. Because that's all it is. It's a requirement that the other party be notified in writing. I think we're just going to cover real quickly. I don't know how much time is here.
Yeah, we got about
5 minutes, okay. What I'm going to do is cover IDs real quick then. Because that's something people have a lot of questions over. When you do a 1031 exchange, you have to do the property identification. There are certain rules that determine whether your identification is valid. The IRS, basically, there's two rules and an exception to this. The first rule, three property rule. That's most commonly used. You can identify any three properties you choose. Doesn't matter how valuable they are. Doesn't matter what kind of property, as long as they're going to be used for investment purposes or productive use. You can purchase one of them, you can purchase two of them, you can purchase all three of them. It doesn't matter. 3 or fewer properties. Write them down, sign the form, date it, and send it in. If an individual, for whatever reason, needs to identify more than 3, then there's a second rule. It's called 200% rule. 200% rule says you can identify as many properties as you want in excess of 3 properties. And you can buy 1, 2, or 3, all the other things apply. But if there's more than 3 properties, those properties, the cumulative fair market value of all those properties combined must be less than 200% of what you sold. So if you sell for $500,000, Under the 200% rule, you can identify as many as you want, up to $1 million. Okay. Where?
Now, that's only if you're, I guess, deferring 500,000, or is it total sale
Nothing to
price?
do with the deferral, it's the number of properties. If you identify 3 or fewer, you can list any 3, regardless of the value. If for some reason you gotta list 4 or more, then you gotta meet that 200% rule. And there's one more exception, and I've had it used only maybe 3 times, and 2 of them were people that were going in, and it was Florida after the housing crunch, and people were going in and buying lots. And their intent was to go into a neighborhood and buy all the lots. And if I can't buy all the lots, I'm not buying any. And they would use what's called the 95% exception. That's the final fallback. Under that rule, or that exception, you can identify as many properties you want for any value you want. Doesn't matter, you can do everything you want. But for it to be valid, you gotta buy 95% of the value of all those properties, which in most cases means you gotta buy them all. So these guys are coming in and buying, identifying 45 or 50 properties, and they worked through, and one of them actually succeeded. He got contracts on all the property he identified. And he went through and he closed on them, and he became the owner of basically an undeveloped parcel of land that it didn't even have the roads built out on it yet. So that was his intent. He wanted to go in and subdivide it. But people already own that property, already own those lots, and Florida real estate, they were buying them in advance. So, the ID rules, definitely you gotta follow. The last thing I'm gonna cover is vesting. The taxpayer of record must be the exchanger. If John Q. Public sells, John Q. Public must buy. If it's, Louisiana's not a community property state. So that's the way it is. John sells, John buys. If John sells and John and his wife buy, they can do that, but John only gets credit for half the purchase. His wife gets the other half. So the exchange is based on the taxpayer's record. In a community property state like Texas, it may be community property. There's a lot more wiggle room. But basically, that's what you gotta look at. Is the taxpayer that sells gonna be the ultimate taxpayer that purchases? There is one way to legitimately change vesting. You mentioned you've got LLCs that you stack your properties in. The formation of a single member limited liability company, technically it's determined to be structured as an entity disregarded for tax purposes under the check the box rule. Now, I've never seen the box. I don't know what the box is to check, but that's how it's described. You can form a single member LLC and structure it so that it doesn't file separate taxes. You file taxes for the LLC on your file, it's personal. And in that case, you may sell property you own individually, buy it in the name of that disregarded entity, and what it does is give you some shelter of liability through that business structure. It's less exposure to liability for you personally, but it would still suffice. The additional cost would be whatever it costs you to do the formation. Just got to make sure you form it, that it's formed correctly, that it's a disregarded entity and not a separate taxable entity. And quite frankly, the rest of this thing is related party exchanges, and basically don't do them.
I got one more question.
Yes, sir.
If I would trade my home for a working farm
Yes, sir.
with the equipment and everything is there, is there any way that I can work the equipment in with that trade?
You used to be able to, but you can't anymore. The IRS in the last 2 years, I believe, a year and a half ago, discontinued when the last tax codes came out. They had the tax breaks and everything. The changes to the 1031 code was they eliminated personal property exchanges. And those items are considered personal property. The ranch or the farm, anything that's affixed to the land, outbuildings, barn, if there's a home there, those are all considered the real property assets.
The timber,
Timber, stand timber,
but no cap.
timber, no. it falls back to state law. I don't think we have a state in our region that allows cattle. But the IRS will recognize how the street, well, actually, cattle, no, not anymore anyway, because they're gonna be considered personal property. I think that was altogether gone. Timberland is still exchangeable.
Now, in the Louisiana buy-sell agreement, maybe you can clarify this, because it's pretty commonplace. It's front page, like line 23, to where we're saying this is to be included with the sale, however, to be deemed as having no value, essentially. And we'll say include the refrigerator and the window coverings, a lot of the times. So with that being the case, could you kind of skew that a bit if you was to buy a farm and they were to include all of that, but have it considering to?
I don't know about equipment on a farm. If you're selling a home and the refrigerator's there, and, you know, dishwasher's usually gonna be affixed.
Yeah.
You know, oftentimes the stoves and ranges are affixed, but the unaffixed, property that goes with it, the IRS and specifics, I'm not 100% sure how they would treat that, but in the past, they've always allowed up to 15% of your sale price.
Okay.
And if the accumulated value of those extras is less than 15% of the sale price, typically it's ignored.
Okay.
And
So you still can work that?
I believe so. If that was something that you were really looking to do and you were doing an exchange, I would suggest, if you do an exchange with our company, basically I do the docs now. I open the files. I see to it that the deeds are in line. I do all the pushing for our region. The documents, the packages, and the deals are then assigned to a coordinator. So what you do is call your coordinator and ask them for guidance. And the first thing they're going to say, if they're not sure, is, let me get you in touch with the boss. And that's what Mr. Brown does. He gets out and he does presentations, but most of his day is dealing with client issues. And he's very hands-on.
I was thinking Bill would sell it for $1 at close too. But again,
Well,
that's kind of stuff that gets me in trouble.
Well, you know, it's effectively that's the same thing. You're saying this is part of the sale price, but it's only worth $1.
Yeah.
Instead of saying this is part of the sale price, but it's less than 15%, you still got the same sale price. And you know, it's gonna allow it through. I can't see anybody having more than 15% for
Not
a few appliances and such.
So you can make it work?
Yeah, there's.
Yeah, there's a way you
You
can
know
make
what?
it work.
What happens with exchanges? A lot of times people will come into the exchange, they won't have a clue what they're planning on doing. But as they come up with their plan and what they want to do, if they do it on their own, they're left to their own recognizance. If they call up their coordinator or call Mr. Brown or talk to me and say, I want to do this, and I'm going to say, well, that could be problematic, but there may be a way. Let's take a look at it before I tell you no. Right? And if it can be done, then fine. And if it's aggressive, then if you want to do it, we'll do it as long as it's not defrauding the IRS. But we're going to strongly urge you to talk to your CPA, your accountant, your tax attorney, and get guidance because you can't take our word for it.
How much does a transaction cost?
$1,000 for a standard delayed exchange. That includes one sale, one purchase. If you sell multiple or buy multiple, each additional sale or purchase is $250 a piece. A commercial property, it's negotiable, but typically $1,250. But you know, if you got a commercial property for sale and you tell me, hey, I'm only going to pay $1,000, that's what you get. We'd much rather have the transaction over a couple of bucks.
How big is it? $30,000 house?
Like I said, I don't do coordinator work anymore. I open files. I opened one for $25,000. People are selling $25,000 and doing a 1031 because they have basically zero tax basis on the property. So it's a $25,000 gain. It's worth $1,000 to wash the capital gains on a $25,000 hit. So even if it's a small transaction, it still may be in your benefit to at least look into an exchange, make a call, talk to somebody that can listen to what it is you're planning on doing, and give you your options, or tell you, hey, you know, it's probably not going to happen. And we'll tell you that just as quick as anything, because again, we can't give advice. All we can do is present you with facts. Okay? As far as moving forward with something that's questionable, you're gonna have to do so at the